All right, everyone, we are going to go ahead and get started. All right, last but not least, we have Morehouse College and Spelman College forming a joint team with their recommendation on Zoom. So with that, you guys can go ahead and get started.
Good afternoon, everyone. My name is Kai Hardiman.
My name is Charles Winfrey.
I'm Kale Cotton.
And I'm Adrienne Craig.
And we are the Spelman and Morehouse team pitching a buy for Zoom with a price target of $115 with a 46% upside.
To give a quick overview of who Zoom is as a company, Zoom is an AI-first application software providing hybrid sources of communication for tomorrow. Zoom was founded in 2011 by founder Eric Yuan with the goal of improving video communications. Yuan was originally working at WebEx and found that the company was not allowing the space for the innovation necessary to bring video communications to the 21st century. With that in mind, he founded Zoom and made sure that Zoom was creating seamless video communication services. Since then, Zoom has changed their name to Zoom Communication Services, finding that there's a greater upside in the communication market as a whole. And since then, Zoom has continued to take advantage of that market. From its new offerings to its continued revenues, Zoom is tailoring itself to its customers, including its enterprise and individual online customers.
Now looking at our investment thesis. We are anticipating a higher than expected growth for Zoom for 3 reasons. The first is their continued expansion into specialized product offerings through their Zoom Workplace platform. The second is their enhancement of core services with AI-powered features, and with these features, we believe that Zoom is poised to reduce churn by increasing their user experience. Recently, Zoom rolled out tailored suites for specific industries, such as the ones on the screen. Outside of these specific tailored suites, there are also applications available across all industries.
So thanks, Kai. To go into that, our entire thesis hinges on Zoom's ability to continually innovate the way that we communicate, and then also on the market's continued buy-in to these innovative products. In 2019, Zoom released the Zoom Phone application, which allows users to communicate through direct phone calls and SMS messaging on Zoom's secure platform. This past year, in 2024, Zoom released the Zoom Workspaces, which Kai mentioned. It allows for AI-first use of the Zoom Phone technology, video communications, and then also Zoom's productivity offerings. So that's the whiteboard, docs, and notes. All of that is also combined in Zoom's Contact Center offering, which was released in 2022 to allow customers to incorporate both Zoom Phone and Zoom's omni-channel customer support services. These services have proven valuable to Zoom's revenues by a recent deal made with a Fortune 100 company that brought in 15,000 new seats to Zoom from specifically the contact center. As Zoom continues to evolve and continues to enhance these products with AI services, Zoom will also be able to rely on their competitive pricing so that these product offerings can continue to prove supportive to Zoom.
Thank you, Adrienne. Zoom's immersive tools seek to capture everyday use and transfer that into lasting retention. And we're already seeing that with net revenue retention. Now, net revenue has declined from 117% to 98%, but that 98% is still strong when you consider that net revenue retention takes into account expansion, contraction, and churn. So that 98% highlights the fact that their customer stickiness as well as customer retention. Also, moving into online churn, falling to 2.7%, really reinforces that stickiness. AI Companion and Zoom Workplace both embed themselves into customer workflows, and which makes it more difficult for said customers to leave or switch to a different service. Now, deferred revenue has surpassed $1.39 billion, which is about 30% of total revenue, which shows that our customers are, Zoom's customers are confident and willing to pay upfront for our services.
All right, so to move now into our valuation. As you see on the screen here, we have 5 different companies. All of these companies really represent a specific market that Zoom is trying to reach into with their new products within Zoom Workplace. So on the screen is reflected of current multiples when we took this sample, and we use the 3 multiples of price to free cash flow, EV to EBIT, and EV to job because these are common multiples we saw through various analyst reports that we reviewed that really helped value Zoom. But what we really want to hone in on is the price of free cash flow. Because as you see, the variance isn't as wide and it's more representative for Zoom. So if you direct your attention to the bottom of the screen, we see Zoom is currently trading at a 13x price of free cash flow, and with an expected growth rate of 12%. And if you compare that to the competitors, the average of the sample that we've taken is a 24x price of free cash flow with a 9% growth. So these multiples are a little compressed right now because analysts are expecting single low-digit growth in addition to a lot of macro factors that are pressing Zoom's multiples down in addition to their increased competition. But with that being said, through the innovation of different Zoom products, specifically the Zoom Phone and Zoom Contact Center, which we believe will drive a lot of Zoom's growth through the enterprise business, and the decrease of online churn, we believe a fair multiple for Zoom to trade at is 20x price of free cash flow, which would represent a $115 price per share.
Now, moving on to our DCF analysis, we calculated a short-term growth rate of 11.6% using the sustainable growth rate method, a long-term growth rate of 3%, and calculated a WACC of 9.4%. With those inputs, we calculated down to an equity value of $35.3 billion. Dividing that by the shares outstanding gave us our target price of $115.
So to help further contextualize really why we believe Zoom is undervalued, we here show something called the Rule of 40. So for context, those of you who don't understand what the Rule of 40 is, it's basically a metric that is used within the software as a service or SaaS industry to really deem if a company is considered financially healthy. So how do you come up with this Rule of 40 score? You take some type of profitability metric plus your growth rate, and that gives you, for the profitability metric, we use the free cash flow margin. And so for Zoom, their Rule of 40 score is 49%, which exceeds that 40% benchmark, which in theory deems by the Rule of 40, Zoom is financially healthy. But if you direct yourself to the chart, you see this dotted trend line shows the average Rule of 40 score for the companies of the sample that we took. And even though Zoom surpasses that 40% benchmark, it still falls well below the average Rule of 40 score for our competitors. So therefore, what do we understand from this is that at Zoom's current valuation, given its performance from its growth percentage and free cash flow margin, we believe Zoom is financially healthy, but yet the current price has yet to reflect that in the market.
Thank you, Charles. Now looking at our sensitivity analysis, the ratio for our case is a 46% upside for the base case and a 3% downside for a bear case. First, starting with the bear case with a price target of $76. For this to occur, there would be a lack of product innovation from Zoom and an increase in competition, which would lead to a decrease in revenue growth. This would result in a 2.7% short-term growth rate and a long-term growth rate that would follow GDP at 2.5%. Now moving on to the base case. For this to happen, Zoom Workplace rollout would encourage growth for its enterprise revenue, and this would yield a 11.6% short-term growth rate and a 3% long-term growth rate. And then we came to a $115 price target. And lastly, for the bull case, and with a $132 price target, for Zoom to get to this price target, Zoom Phone and Contact Center would have to perform higher than our expectations, and this would result in a 11.6% short-term growth rate and a 4% long-term growth rate.
Now on to our risk and mitigants. First, we identified the risk of market saturation and slowing growth. So the core video market is maturing, and analysts forecast that low forward growth and compressing the valuation. However, Zoom is no longer just falls within the core video market. It has expanded to the software as a service, expanding their total addressable market. The competitive pricing nature. So players like Microsoft Teams, Google Meet may undercut Zoom on pricing. However, we are confident in Zoom's products and their services, and we feel that that's not going to be a problem in the long run. Now, for feature overload, the rapid product rollout could overwhelm users, reducing engagement. However, citing back to the earlier slides, Zoom's customers are both confident and consistent, and so we feel that this philosophy will continue moving forward.
And with that, we would like to thank you all for your time and open the floor for questions.
Can you go back to your comps slide, please? I'm struggling to understand why Duolingo is an appropriate comp for Zoom. So can you just talk to me about why you thought that there are parallels to Duolingo's business relevant compared to Zoom?
Yeah, Mr. Goins, thank you for your question. So the reason we use Duolingo, if we look within Zoom Workplace, they have multiple features. It's a lot of different platforms, but specifically with Duolingo, it's a leader in the ed tech and really the virtual assistance in learning. And as we know, through Zoom, through COVID and through addition now in the classroom, we see Zoom as an everyday use. So therefore, we thought it was appropriate to really compare Zoom to a type of industry that the company wants. Compare Zoom to Duolingo, which is some space that Duolingo leads in, that Zoom wants to touch into and continue to expand upon. So that's why we thought Duolingo was a fair comp.
And I'd love to add a little bit to that. Duolingo offers a number of services within a single platform, similar to how Zoom is offering a number of services and products within one single platform. And because they're built so similarly, they're both digital, and they both are made with the goal of incorporating AI into learning or use spaces. We think that they're pretty comparable because at their very base, if we strip away what they're being used for, the idea and the actual software that's being used and sold is completely comparable.
Great presentation. Is that growth rate revenue growth on the right there?
Yeah,
or cash flow growth?
It's actually what we used was the sustainable growth rate method. So to put that in context, it's basically the retention ratio times your ROE. And we thought this was really important to use for all of these companies because the sustainable growth rate assumes that a company, this is how much they can grow if they don't take on any external financing. And when we compare that to Zoom, we thought Zoom has had the 99% equity and very low percent of debt. And so when we're comparing, we thought this would be a best representation of Zoom because they haven't seemed to change their capital structure over time.
Thanks. Just a quick question on competition because it's so important to businesses like this. How has pricing been trending for this business? What's going on in the competitive set? And I have one follow-up on free cash flow, which I love.
I can take that one. I think it's interesting to notice that a lot of the competitors that are directly competing with Zoom's video conferencing software are things like Google and Microsoft, who have complete suites that expand past just the communication software. Google has Google Docs, Google Drive, all of these things that add on, or even Google, I want to say, similar to AWS, Google has cloud computing services. All of those things add to their general revenues and all of their sheets, so we can't exactly compare them company to company. Zoom is not comparable to Microsoft because Microsoft builds computers and Zoom doesn't at this moment. But I think that it's really important to notice that that's a very distinct difference. So the pricing of these are going to be completely incomparable. Microsoft is not pricing Microsoft Teams specifically. You're buying the Microsoft suite. Zoom is sort of moving into that space by including Zoom Workspace, but in general, Zoom is having you buy a specific product and allows you the opportunity to pick and choose what you need from Zoom. With that in mind, the general prices are of course increasing. Zoom is making sure that they are staying competitive by allowing AI to be integrated without an additional charge. That is to be continued to be rolled out. Of course, there's going to be a charge to some levels of AI use, but right now, Zoom is making sure that it is the most competitive on the market by offering its services, including AI and other upgrades, but keeping their original prices.
Good answer. Very quickly on free cash flow, which is the basis of a lot of your valuation. A lot of companies like this don't generate it. If I were management sitting in front of you today, what would you recommend that I do with these piles of cash that are either on the balance sheet or that I'm bringing in every year by charging customers?
Yeah, I'll take that question. So if we look at the financial profile of Zoom, they have about roughly $8 billion in cash, and it's almost a third of their market cap actually. And so a lot of that was established during COVID. There was this inflow of so much demand, so they could build up so much cash on their balance sheet. So it's funny, I've been asking myself the same question, why has Zoom not deployed that cash yet in an effective manner? So to answer your question, it's really so many different things that they can do. I think number one is acquire some type of asset that can help assist grow this Zoom workplace or other areas where they may see different competition. But overall, I believe expecting some type of strategic acquisition would be the best way to deploy that cash.
Do you think Zoom itself could be an acquisition target?
100%. I believe so. I've been wondering why different competitors within the space, such as Microsoft or Google, they can take out their biggest competitor, and the market cap's only roughly $26 billion. So I believe Zoom is a prime acquisition target. Again, with $8 billion in cash and such low debt, and they have such a wide market share, and continue to innovate, I think it's a prime acquisition target.
And to add on to that, we've also thought a little bit about why they haven't been acquired yet. We think that there's a couple of compliance issues. If a Google or Microsoft acquires Zoom, it's a monopoly. And obviously that leads to other issues that might have to go to the courts. And so we think that Zoom has uniquely positioned in that way, because if they are acquired, then whatever company acquires them will face other issues with whether or not they're a monopoly. Whereas Zoom has the opportunity to continue growing and continuing to scale through the markets that they're in and expand into new markets without facing that issue.
One business that we've considered is a healthcare company, potentially being able to make a telehealth company. Zoom is rolling out features that will help healthcare companies keep track of their notes and visits that they have with clients or patients as well, and they've also added on some cyber techniques to protect their information.
Great. One other one on your base bear bull. Your bear case is essentially the stock stays flat, but maybe in a worst case scenario, what do you think Zoom really struggles with in 3 to 5 years if things go south?
Yeah, that's a great question. So in our bear case, right now, through the price, analysts have almost 2-3%, such low single-digit growth top line. So worst case scenario could be competition again increases and we see margins start to decrease. I think the biggest thing with Zoom is if that market share or the video conferencing kind of industry begins to dry up or mature, that can be the biggest threat. And then in addition, if the product innovation doesn't really exceed expectations of what they had, specifically with the phone and contact center, I think that could be kind of a doomsday scenario for Zoom where they begin to lose that market share and the product innovation isn't as high as they think.
Does your valuation include that $8 billion of cash on the balance sheet?
It did, yes sir, it did.
At school, do you primarily use Zoom, Teams, Google?
We use Zoom a lot actually for meetings, for this.
For the matter of the pitch, we use Zoom.
Yes. And we noticed that you all use WebEx here, which was an interesting thing to us. And if you guys can, we'd love to hear about why you guys use WebEx instead. As a corporation, that would be a target audience or customer for Zoom.
Any other questions from the judges?
Yeah, what happened with the security questions that they had several years ago? Have you fixed that?
Yes, definitely they have. Zoom made sure that they are incorporating the option for users to choose which servers or which sort of databases. I don't know if you know about sort of how data is stored and servers are stored in warehouses in certain locations, so that a platform or an online service can be accessed across the world. So Zoom has data servers, or I don't remember the exact terminology, but it's a space that is real estate that is specifically dedicated to housing servers, power banks, and other aspects that allow the cloud computing services to continue running. Zoom makes sure that those are across the country. So there's some in the US, some in China, some in Europe, and some in the Middle East. And as a user, you can determine which server you want your call to go through, so that if you're worried about security, you don't have to think about whether or not your calls are going through China. The government has access to them. In addition, Zoom has upgraded their end-to-end security systems, upgrading their cybersecurity and specifically encoding everything so that there's sort of an added layer of security across Zoom Phone, Zoom Meetings, and sort of all of the Zoom platforms.
Awesome. If there are no other questions from the judges, great job, Morehouse College and Spelman. Just realized you guys asked me what we use today. We are